would like to welcome you to Stefanutti Stock's interim financial results webcast for the 6 months ended 31 August 2021. This presentation will be available on our website. I would like to start our presentation with an update on the progress made to date on the various aspects of the restructuring plan. In accordance with the restructuring plan, the lenders had provided the group with a total funding of 1.205 billion, the majority of which was anticipated to be repaid by the end of February 2022. Due to the slower than anticipated sale of certain operations, a delay in the regulatory processes relating to the disposal of Altai stocks, and the non-implementation of the materials handling and tailings management subdivisions transaction, the capital portion of the loan repayments envisaged to commence in July 2021 had not materialized. The group is currently in negotiations with the lenders to extend the capital repayments and the duration of the loan to 28 February 2023. Following the receipt of the initial purchase consideration of 92 million on 8 November 2021 for the disposal of Altai stocks, a capital repayment of 45 million was made on 15 November 2021. Interest on the loan is serviced on a monthly basis. The group continues to evaluate an optimal business model and associated capital structure. The sale of non-core assets as at the end of October. The following properties have been sold. One of our formwork yards in Midrand for 28 million, a residential property in Sasolburg for 500,000, the remaining units of the Northern Views residential development in Pretoria with net proceeds of 24.4 million, vacant industrial land in George for 1.4 million, and an industrial property in Kempton Park for 1.9 million. The following properties are in the process of being sold. 2 residential development properties in Pretoria and Midrand, vacant industrial land in Sasolburg, and an industrial commercial fabrication workshop in Isando. The sale of certain operations. Mining Services Division. As announced on 23 August 2021, shareholders were advised that not all conditions precedent relating to the sale of materials handling and tailings management subdivisions had been fulfilled or waived, and consequently, the disposal could not be implemented. These disciplines had been retained and therefore reclassified as part of continuing operations. During the protracted sale process, the order books of these disciplines were severely eroded due to extensions on existing contracts not being granted and clients excluding these disciplines on tender invitations and the resignation of key staff. We are currently refocusing and rebuilding these disciplines, including the re-employment of the senior management team that had previously resigned. Good progress has already been made in operations with an improvement in the order book. United Arab Emirates operation. The transaction relating to the disposal of 49% of the entire issued share capital of Altai stocks was approved by shareholders on 31 August 2021. All conditions precedent relating to this transaction had been fulfilled by 31 October 2021. In accordance with the terms of the transaction, the group received the initial purchase consideration of 92 million on 8 November 2021. As set out in the circular issued to shareholders on 3 August 2021, the balance of the purchase consideration, being the equity value adjustments and retention amount, is based on Altai Stocks' ability to successfully settle outstanding claims and final accounts on certain projects. As at the end of October, the sale of underutilized plant and equipment, including plant that has reached end of useful life, a total of 124 units with a sales value of 58 million and a net book value of 31 million had been sold. There remains 84 units to be sold. Winding down of contract mining subdivision. During the comprehensive sale process, no offers were received for the contract mining subdivision. As a result, this subdivision had been wound down, with the last project completed in October 2021. Contract mining plant is in the process of being sold. To date, a total of 97 units with a sales value of 152 million and a net book value of 138 million had been sold. Within this reporting period, a total of 27 million of outstanding installment sales relating to all contract mining plant and equipment was settled. there remains 22 units to be sold. Recovery of historical slow-paying receivables. With respect to the outstanding amounts due by the Zambian government, 18 million has been collected since the beginning of the financial year. The timing and quantum of receipts remains irregular. We anticipate collecting a further 48 million at current exchange rates. With respect to a contract mining debtor who defaulted on their payment terms, for which 30 million was provided for in August 2019, the group had debtors insurance on this contract. The insurer initially repudiated our claim. During arbitration proceedings, the parties agreed an interim settlement of 9 million. A repayment plan has been entered into with the mine owner to recover 12 million over the next 3 financial years. New organisational structure as a result of our restructuring initiatives. Effective from 1st March 2021, the group has reorganised its operations into regions with the exception of the mechanical and electrical business, which has been renamed Mechanical Electrical Piping, comprising the following disciplines: mechanical, electrical and instrumentation, and oil and gas. The inland region comprises the following disciplines: roads and earthworks, civils, geotechnical, building, materials handling, and tailings management. The coastal region comprises the following disciplines: roads and earthworks, civils, marine, and building. The Western Cape region comprises the following disciplines: civils and building. The Africa region offers multidisciplinary expertise in Eswatini, Zambia, Botswana, and Mozambique. SSBR joint venture package 16 update. Update on all construction. All construction work is complete, inclusive of snagging. A small maintenance team will, however, remain on site until December 2021, dealing with any defects. Commissioning remains on track to be completed by December 2021 for all areas where access and services are available. If Eskom is unable to give access to certain works by December 2021, these works will either be undertaken in 2022 or on a cost-plus basis, or will be removed from our current scope. Update on measurement. The sectional final measurement process remains ongoing. Good progress has been made, resulting in positive certification and payment. Eskom continues with their adverse approach to certification, but SSBR has been able to motivate certification in the amount of 47.3 million for this period, with 21.2 million received and the balance due on or before 16 December 2021. Measurement, new rates, and other items that the parties are unable to resolve will be referred to the Dispute Adjudication Board, known as a DAB, for a decision. Update on delay. As previously mentioned, the group and Eskom have both committed to a claims resolution process for all causes and delays to the end of December 2019, which involves the appointment of independent experts to evaluate the causes of delays and the quantification thereof. The contract comprises 77 sections. With respect to each section, both parties' delay analysis experts have completed all analysis and submitted their final differences to the DAB for a decision on the delay entitlements. Meetings led by the DAB started during November 2021. The DAB will issue advice and decisions, after which the final entitlement will be calculated by the delay analysis experts through the joint drafting of a final expert report. This will be followed by the quantum experts, who will calculate the financial entitlements consequent upon such delays. Update on quantum. The independent quantum experts are in the process of completing their exercise of interrogating the total costs which have been incurred on the project. The interrogation was conducted on a sampling basis, and to date no anomalies have been found. In addition, the quantum experts are in the process of agreeing the methodology to apply the project costs to the delay entitlements to quantify the financial consequences of the delays. The parties are still on track to substantially resolve the disputes by February 2022. Other claims post-2019. The JV was successful with its COVID-19 claim, with a final award on the quantification expected during the month of November 2021. After December 2019, a further 77 site claims have been submitted to the engineer, of which 30 include additional cost claims. This deals with a period from December 2019 to the end of the contract. The engineer has to date only responded to 14 of the 77 site claims. Following the successful dispute of the COVID-19 claim award, the engineer has acknowledged that his interpretation of the contract may be incorrect and therefore needs to reassess all submitted site claims. All disputed claims will be referred to the DAB. Stefanutti Stocks Izazi Joint Venture Package 28 update. During June 2018, the JV commenced adjudication proceedings in relation to numerous compensation events which had not been assessed. During February 2019, this contract was terminated due to Eskom's inability to provide access to the JV to complete the works. The engineer issued 2 negative final payment certificates in August 2019 and April 2020 respectively, alleging overpayments had been made to the JV. This prompted the notification of many new disputes, which were then included in the adjudication process. Adjudication hearings were conducted during November 2020 and February 2021. As several disputes relate to measurement of the works, the JV and Eskom have embarked on an independent expert process to resolve these disputes. In order to accommodate this independent expert process, the adjudicator has been requested not to publish his decision. The independent experts are still on track to substantially complete the measurement of the build quantities by February 2022. Given the magnitude of the amounts in dispute, it is highly probable that the disputes will be referred to arbitration. The civil unrest experienced in the month of July 2021 directly impacted the inland and coastal regions. The inland region had 3 sites within the Greater Gauteng region that were unable to work for approximately 1 week, affecting the revenue generation for the month of July. These are fairly small sites and no theft or damage was reported. With respect to the coastal region, all of their 14 sites were unable to work for between 7 and 10 working days, having a significant impact on revenue generation for the month of July. There was 31 million damage to completed works and 5 million damage to plant and equipment. We are in the process of finalizing claims with our brokers to submit to SSBR. Progress on the sites was further delayed due to the consequential shortage of diesel and strategic materials. The effect on the operating profit due to the civil unrest in both these regions is calculated at 8 million. The group is pursuing its entitlements with respect to the extension of time claims on some of the affected sites. Political unrest in Eswatini. Access to sites were blocked by protesters and employees were physically threatened, necessitating sites to close for a couple of days up to a maximum of 2 weeks. As a result of vandalism, minor damages were suffered to property and plant. Supplied materials and equipment was affected during this period. The unrest has had a minor impact on the region's interim results. Currently, the situation has stabilized and all operations are continuing as normal. COVID-19 update. Stefanutti Stocks' priority continues to be the health and safety of its employees. The management of the group remains committed to supporting the initiatives that the governments have implemented with respect to the COVID-19 pandemic in the various countries in which the group operates. Importantly, Stefanutti Stocks continues to adhere to the required protocols and maintains a close working relationship with clients and key stakeholders to mitigate the extensive impact of COVID-19 and reduce the long-term effects on the group. I would now like to discuss the COVID-19 statistics and vaccination status. Statistics. We are constantly monitoring and tracking all COVID-19 cases within our business. As at the end of August 2021, we had a total of 609 positive cases, of which 60 relate to subcontractors, with 569 recoveries, representing a recovery rate of 93%. Limpopo province has the highest number of positive cases of 148 with 94% recoveries. Regrettably, 3 employees and 1 subcontractor succumbed to COVID-19. We no longer have any staff members working remotely. Due to the reduction in headcount, office space has been freed up, allowing us to observe the required social distancing protocols. Vaccination status. Since vaccinations became readily available to the wider population, the group has embarked upon a vaccination drive through awareness campaigns, arranging for mobile clinics to visit the larger and more remote sites for mass vaccinations, providing transport to vaccination centres from local sites and office campuses, and granting employees paid leave upon proof of vaccination. The group has set up a portal to measure the vaccination status. The following employee categories have been fully vaccinated: 33% of monthly paid limited duration contractors, 44% of monthly permanent employees, 30% of hourly permanent employees, and 19% of hourly limited duration contractors. 26% of all employees have been fully vaccinated, currently above the national rate of 22%. I shall now cover the key indicators for continuing operations. In line with the restructuring plan, the group has initiated a disposal program to sell certain operations which have accordingly been reclassified as discontinued operations. Consequently, the results for this period and the comparative period have been prepared to reflect continuing and discontinued operations. There has been an increase in contract revenue to 3.2 billion when compared against restated August 2020 of 2.6 billion. The group is reporting an operating profit of 5.4 million when compared against a restated operating loss of 161 million in August 2020. The group's order book at September 2021 is 4.6 billion for continuing operations. The other financial indicators will be covered by Yolanda later in the presentation. Management and staff remain committed to our health, safety and environmental policies and procedures, and together strive to constantly improve the group's health, safety and environmental performances. The group's lost time injury frequency rate and recordable case rate at August 2021 was 0.03 and 0.3 respectively. The group continues to be a level 1 broad-based black economic empowerment contributor, measured in terms of the construction sector scorecard with a black economic interest score of 64.28%. I would like to explain what a normalized operating profit would be for the group for this period. Included in the results are the following abnormal and non-operational items: restructuring costs of 48 million, abnormal legal fees of 10 million, a fair value adjustment of 15 million relating to an industrial and commercial property held for sale, the negative impact of civil unrest of 8 million. By excluding these amounts, normalised trading would have been an operating profit of 86 million at a 2.7% operating margin. I shall now discuss the performance of the regions. The focus of the group is to reduce the number of loss-making projects and return the group to profitability. For the reporting period, of the 151 active projects, 25 projects declared contract revenue of 102.3 million, reporting an aggregated operating loss of only 19.9 million, indicating no material loss-making contracts. 59% of the reported contract revenue was executed at better than tender margin. We will continue with our drive to achieve a minimum of tender margin on all projects. The inland region's contract revenue from continuing operations is 1.1 billion compared to the 1.3 billion as restated for August 2020, with an operating profit of 34 million compared against an operating loss of 65 million in August 2020. The reduction in contract revenue is attributable to the winding down of the contract mining subdivision, the non-implementation of the materials handling and tailings management subdivision transaction as mentioned previously, and the delay in tender awards. The following disciplines performed in line with budget: roads and earthworks, geotechnical and civils. 53% of this region's contract revenue was executed at better than tender margin. As previously reported with respect to 2 contract mining project terminations, the arbitration matters remain ongoing. The group is confident that the terminations were lawful and therefore no provision has been made for these. Both arbitrations are expected to be completed in the next financial year. Percentage turnover and order book by sector for continuing operations only. The yellow indicates contract revenue for the period, with the blue indicating the current order book within the various sectors. 66% of reported contract revenue was in surface mining related services, bulk earthworks and energy generation. In the current order book, 85% is in building other, surface mining related services and transport infrastructure. The order book at September 2021 was 1.6 billion. Opportunities exist for this region in transport infrastructure, water and wastewater treatment plants, mine infrastructure, and in the renewable energy sector. In the short term, there are potential awards to the value of approximately 5.1 billion, and for the future, projects to the value of approximately 26.2 billion have been identified. The coastal region's contract revenue from continuing operations is 491 million, compared to the 433 million as restated for August 2020, with an operating loss of 2 million compared against an operating loss of 21 million in August 2020. The region's profitability was negatively impacted by 8 million due to the civil unrest. 29% of this region's contract revenue was executed at better than tender margin. Percentage turnover and order book by sector for continuing operations only. 89% of the reported contract revenue was in building other and water, sanitation and pipelines. In the current order book, 88% is in water, sanitation and pipelines, bulk earthworks and building other. The order book at September 2021 was 888 million. Opportunities exist for this region in transport infrastructure, water and wastewater treatment plants, commercial, retail and industrial projects in the private sector. In the short term, there are potential awards to the value of approximately 966 million, and for the future, projects to the value of approximately 21.2 billion have been identified. The Western Cape region's contract revenue for continuing operations is 677 million compared to the 139 million as restated in August 2020, with an operating profit of 22 million compared against an operating loss of 15 million in August 2020. The building discipline performed in line with budget. 90% of this region's contract revenue was executed at better than tender margin. Percentage turnover and order book by sector for continuing operations only. 69% of the reported contract revenue was in building, factories and warehouses. In the current order book, 69% is in building other. The order book at September 2021 was 458 million. Opportunities exist for this region in water and wastewater treatment plants, framework agreements, and commercial, retail, industrial plants, warehouses and data centers in the private sector. In the short term, there are potential awards to the value of approximately 728 million, and for the future, projects to the value of approximately 8 billion have been identified. The Africa region's contract revenue from continuing operations is 744 million compared to the 485 million as restated for August 2020, with an operating profit of 48 million compared against an operating profit of 25 million in August 2020. The following disciplines performed in line with budget: Eswatini, Zambia and Botswana. 72% of this region's contract revenue was executed at better than tender margin. Percentage turnover and order book by sector for continuing operations only. 96% of the reported contract revenue was in transport infrastructure, building, office and commercial, water and sanitation pipelines. In the current order book, 87% is in transport infrastructure and building, office and commercial. Mozambique's order book is currently under pressure, impacted by the ongoing political unrest in the northern province. The order book at September 2021 was 1.6 billion. Opportunities exist for this region in transport infrastructure, water, wastewater treatment plants, pipelines, dams, strategic fuel farms and commercial, retail, office, leisure, warehouses, mine infrastructure, renewable energy and industrial projects in the private sector. In the short term, there are potential awards to the value of approximately 793 million, and for the future, projects to the value of approximately 13.9 billion have been identified. Mechanical electrical pipings contract revenue from continuing operations is 175 million compared to the 179 million as restated for August 2020, with an operating loss of 37 million compared against an operating loss of 32 million in August 2020. As mentioned earlier, included in these results is a fair value adjustment of 15 million relating to a property held for sale. This business has been severely impacted by the effects the COVID-19 pandemic has had on global commodity prices, resulting in major plant maintenance and upgrade projects being put on hold. Due to the ongoing shortage of available work in all disciplines, all cost-saving opportunities have been taken, including optimum right-sizing. With respect to the oil and gas disciplines arbitration matter relating to the cancellation of a petrochemical contract, which had to be postponed due to a fundamental change in the client's defence, no correspondence has been received on this matter since May 2020. A date for the arbitration is yet to be set. At this stage, the financial impact thereof cannot be quantified. With respect to the mechanical disciplines project termination, the arbitration is scheduled to be heard from the 22nd March 2022 to 22nd April 2022. The group is confident that the termination was lawful and therefore no provision has been made. Percentage turnover and order book by sector for continuing operations only. 84% of the reported contract revenue was in industrial plants, oil and gas. In the current order book, 92% is in industrial plants, oil and gas. The order book at September 2021 was 53 million. Opportunities exist for this business in renewable energy, industrial projects, clean fuels, tank farms, data centers, mining infrastructure, and plant upgrades, shutdowns and maintenance. In the short term, there are potential awards to the value of approximately 450 million, and for the future, projects to a value of approximately 8.1 billion have been identified. This slide is a consolidation of the group's actual contract revenue and September 2021's order book by sector for continuing operations. 14% of contract revenue in South Africa comes from the public sector, consisting of water, sanitation and pipelines and transport infrastructure. 17% of contract revenue outside South Africa is in the public sectors of Botswana and Eswatini. 36% of the current order book of 4.6 billion is from outside South Africa. In the short term, there are potential awards to the value of approximately 8 billion, and for the next 12 months, projects to the value of approximately 77.5 billion have been identified. I shall now cover some guidance for the next 6 months of continuing operations. Inland region, we expect contract revenue to remain consistent with a similar operating profit margin as currently reported. Coastal region, we expect a slight increase in contract revenue with a marginal operating profit. Western Cape region, we expect a reduction in contract revenue with a similar operating profit margin as currently reported. Africa region, we expect contract revenue to remain consistent with a slight reduction to the operating profit margin as currently reported. Mechanical electrical piping, we expect contract revenue to remain consistent and a similar operating loss as currently reported, excluding the impairment of 15 million. Included within head office are abnormal restructuring costs comprising advisory, legal, and funding fees relating to the restructuring plan. For the next 6 months, we expect similar costs as currently reported. I would now like to hand over to Yolanda for the financial overview.
Thank you, Russell. These results are in line with the trading update released on SENS on 10 November 2021 indicating earnings per share and headline earnings per share for continuing operations to reflect a loss of between 50 and 70 cents. These results are characterized by the continued pressure on working capital and the funding of the Kusile building project, SSBR JV Package 16, resulting in the group continuing to experience short-term liquidity pressures. In line with the restructuring plan, the group has initiated a disposal program to sell certain operations which have accordingly been classified as discontinued operations. These disposals are expected to be concluded within the next 12 months. Consequently, the results for this period and the comparative period have been prepared to reflect continuing and discontinued operations in accordance with international financial reporting standards. Some financial indicators relating to continuing operations. Contract revenue, 3.2 billion. Operating profit of 5.4 million. Adjusted operating profit of 63 million, excluding restructuring fees and abnormal legal fees. Headline loss per share of 60 cents and a headline loss per share of 67 cents for total operations. Moving on to the statement of profit or loss. With respect to continuing operations, contract revenue for the Western Cape and Africa region increased by 538 million and 259 million respectively, resulting in an overall increase in contract revenue from 2.6 billion to 3.2 billion. The EBITDA profit improved by 139 million due to the profitability of the Inland, Western Cape and Africa regions. Adjusted EBITDA of 121 million, excluding restructuring fees and abnormal legal fees of 58 million. The depreciation charge has reduced to 40 million from 64 million of the comparative period, which includes an IFRS 16 right of use charge of 4 million. A fair value adjustment of 17 million was recognized, of which 15 million relates to a property and 2 million for plant and equipment, which has been classified as held for sale. This resulted in an operating profit of 5 million compared to a loss of 161 million for the prior period. Excluding restructuring fees and abnormal legal fees, adjusted operating profit is 63 million. Interest received reduced to 10 million. Interest paid for the period amounted to 60 million, of which 50 million relates to the term loan. Interest paid on right of use remained the same at 2 million. The group at this stage has not provided for a deferred tax asset on the losses pertaining to the South African operations. The tax charge is impacted by the profitability of the cross-border operations at their varying tax rates. Loss for the period from continuing operations is 103 million. The discontinued operations reported a loss of 85 million, of which 71 million relate to a fair value adjustment for Altair stocks. Loss for the period for total operations amounted to 188 million. Headline earnings per share for continuing operations is a loss of 59.88 cents per share, and headline earnings per share for total operations is a loss of 67.12 cents per share. Moving on to the statement of financial position. CapEx spent for the year is 7 million, excluding 1 million IFRS 16 right of use assets. Of the traditional CapEx, 6.6 million relates to maintaining operations. Work in progress has increased from 611 million to 710 million, in line with the increased trading activity. There has been a 7% decrease in trade accounts receivable, with a corresponding reduction in debtors days from 75 days to 58 days. Non-current assets held for sale and disposal groups amount to 870 million. Net cash on hand is 531 million. The group on 1 July 2020 entered into a term loan agreement with its lenders on standard terms and conditions applicable to this type of funding, amended on 25 May 2021, terminating on 28 February 2022. Due to the slower than anticipated sales of certain operations, a delay in the regulatory processes relating to the disposal of Altair stocks, and the non-implementation of the materials handling and tailings management subdivisions transaction, the capital portion of the loan repayments envisaged to commence in July 2021 had not materialized. The group received the initial purchase consideration of 92 million relating to the Altair stocks transaction on 8 November 2021. A capital repayment of 45 million was made on 15 November 2021. The group is currently in negotiations with the lenders to extend the capital repayments and duration of the loan to 28 February 2023. Lenders continue to provide guarantee support for current and future projects being undertaken by the group. The directors consider it appropriate that the group's results for the reporting period be prepared on a going concern basis, based on having converted the short-term funding agreement with the lenders to a term loan, the assumption of a successful completion of current negotiations with the lenders with regards to the extension of the capital repayments and loan duration to February 2023, ongoing support from the lenders, and successfully implementing the restructuring plan. The funding provided by the lenders has assisted in relieving the group's liquidity pressures, even though current liabilities exceed current assets as at 31st August 2021. The group believes that it is still currently commercially solvent based on the cash flow projections included in the restructuring plan. However, uncertainty surrounding the COVID-19 pandemic and contingent liabilities, as noted in Note 26 of the group's consolidated annual financial statements for the year ended 28 February 2021, continue to indicate that a material uncertainty exists that may cause doubt on the group's ability to continue as a going concern in the short term. Moving to the liability side of the statement of financial position. Total interest-bearing liabilities have decreased slightly from 1.55 billion at February 2021 to 1.52 billion. As previously mentioned, the group is currently in negotiations with the lenders to extend the capital repayments and duration of the loan to 28 February 2023. A capital repayment of 45 million was made on 15 November 2021. Trade payables, accruals and other current liabilities have increased from 1.3 billion to 1.4 billion. Excess billings over work done has in total decreased by 117 million to 1.1 billion. There has been a 76 million reduction in total provisions to 516 million from 592 million in Feb 2021. Liabilities associated with disposal groups held for sale amount to 227 million. Moving on to the statement of cash flows. The cash flow statement is presented for total operations. Cash consumed from operations is 141 million, which is in line with the results for total operations. Working capital consumed 52 million as opposed to the 8 million generated in the prior year. Other investing activities comprises the sale of all plant and equipment. Financing activities reflect a net 80 million reduction in total debt during the period. All in all, there has been a decrease in cash from February 2021 of 225 million to 531 million, excluding cash of discontinued operations amounting to 55 million. In conclusion from my side, successfully implementing the restructuring plan and focusing on a positive resolution with respect to the Kusile power projects remain the top priority. I will now hand back to Russell to close the presentation.
Thank you, Yolanda. We'll now cover industry-related matters. With respect to the civil claim received from the City of Cape Town, the arbitration hearing commenced but was subsequently adjourned and postponed to July 2022 at the request of the City of Cape Town. The group remains confident it can defend this claim. With respect to the voluntary rebuild program and our request for deferment of the 2020 contribution to the Tirizano Construction Fund, the DTIC have appointed an independent financial analyst to audit our request for COVID-19 relief. We are in the process of submitting the required information and expect to receive feedback before the end of 2021. Should we receive a positive response, the 2020 contribution will be deferred to 2028. The group continues to be negatively affected through disruptive and unlawful activities by certain communities and informal business forums in certain parts of South Africa. In conclusion, our focus is on the successful implementation of the restructuring plan, achieving favourable outcomes from the processes being undertaken on the Kusile Power projects, continue driving the collection of all outstanding slow-paying receivables, and continue our focus on the reduction of loss-making projects and returning the group to profitability. This brings us to the end of our presentation. We are now available to respond to any questions that you may have. Thank you.